Hello and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague Lawrence Gillum to kick off Thanksgiving week. Lawrence, I think you're going to talk a little bit about the holiday here in a minute. But first, I got to share this when our personal lives and our market lives match. I find it really fascinating. So I had a cold last week. My cough was really bad Wednesday, Thursday. That's when the market was bad. I recovered on Friday. That's when the market recovered. What do you think? Coincidence or not?
I feel like I should say something about correlation not being causation here, but who knows these days? Stranger things have happened. Maybe you were the cure to the markets.
Maybe so. Or maybe the markets just affect my health.
Or
Maybe that's the causation. So, hope everybody has a great holiday. I'll start with that up front. I guess, Lawrence, we talked a little bit before we jumped on here about Thanksgiving plans. You and I aren't really doing anything too exciting.
we're not. Yeah, we have no plans this year, which I'm actually looking forward to. I have family in Florida and then in Northern Virginia, and normally we would be driving to both of those locations, but this year we're not doing that. We're gonna do that for Christmas instead. So this Thanksgiving though, we're gonna be here in Fort Mill and just watching football and enjoying the family time.
Very good. Well, hopefully enjoying a Chiefs win. The My plans are similar. We're just getting over this cold. We passed it around. All four members of the family, not the dog, but all four members of my family got this thing. We took turns. Now my wife Debbie has it, but hopefully she'll be better by Thursday, and we can do Thanksgiving with the in-laws. So staying local. We got a good show for you today. It's We got some great topics, even though it's bond market related. It's exciting. I know, Lawrence, you'll agree. But we'll mix in some earnings talk too. We just finished third quarter earnings season. That's the topic of the weekly market commentary for this week, which you can find on LPL.com. So we'll do that too, in addition to recapping the week last week and previewing the week ahead. I titled this Stale Data, Fresh Turkey. But really, I think the key to keep in mind with stale data is that the Fed has limited visibility. We'll get to that in a bit. All right, starting with the market recap. I called it a whirlwind of a week because we had that massive reversal in the stock market on Thursday. Initially at the open, market loved what it had heard from Nvidia on Wednesday, got a rally north of 1%. But then intraday, these worries about whether all these AI bills will be paid started to really reverberate. And you ended up not only causing all those gains to evaporate, but then down another 1%. So the S&P 500 went reversed negatively by about 3.6%, I think, intraday. So it was a huge it was a huge move. One of the top three biggest intraday sell-offs from that high point to that low point that we've ever seen. So certainly some of the technicians are, including our own Adam Turnquist, are calling that a little bit of a near-term negative signal. We'll have to see. But if you go back and look at history after those reversals, if you kind of widen the pool and look at maybe the biggest 30 reversals ever from big gains to big losses, the returns from that point forward in subsequent months tend to be pretty good, similar to the market on average. So we're not too worried about that, but we do think there might be a little bit more downside in the near term before we get the Santa Claus rally. The S&P did end up down 2% for the week. The NASDAQ did a little bit worse, down almost 3%, which makes sense when you have worries about AI. So you see tech down almost 5 for the week. You see consumer discretionary, which of course has Amazon and Tesla, tech-like. Those were quite weak. On the flip side, though, Alphabet, aka Google, was a huge winner last week. The Berkshire Hathaway stake certainly helping there. So comm services actually leading. It's our favorite sector, actually leading the market last week. And kind of dampening, I guess, the whole tech sell-off narrative just a bit. International markets lagged last week. The EFA and the emerging market indexes were down almost 4%. The strong dollar was certainly part of that. And then we had some jitters in Japan around potentially overspending. This is your world, Lawrence. Yen weakness, maybe too inflationary, too much spending, budget troubles kind of leaking in there, and then some tough talk from the new prime minister there about Taiwan certainly didn't help. So you see some weakness in Japan and in the Hong Kong / China equity markets. Turning to bonds and commodities currencies. So Lawrence, good week for bonds. AI was one story and that reversal on Thursday, but I think the other big story last week was just all the Fed whipsaw. I mean, we're going to get a December cut or not? Who's speaking, right? Is it the Doves or the Hawks?
Yeah, that's right. It's a very divided Federal Reserve right now, which we'll talk more about in just a second. But we did get a decent rally out of the bond market last week after the regional Fed president, John Williams from the New York Fed, discussed his views on the potential for rate cuts. And he came out on the affirmative side, and that bond markets liked that narrative. And it looks like we're still going to keep fighting back and forth between the Hawks and the Doves until we get closer to this December meeting. But last week we did get some relief out of the rates market. We did see Treasury yields across the curve move lower. The result was about a 50 basis points return out of the aggregate bond index. Pretty broad-based. Mortgages up 40 basis points. Investment grade corporates up about 40 basis points. I always like to focus on the year-to-date returns, especially since I tend to go after the equity markets, and equity markets are always, you have these big numbers. But this year's been a pretty decent year out of the fixed income markets. You get an 8% type return out of AAA rated mortgage-backed securities. So it's been a good year. Now, we probably pulled some of these returns forward from 2026. We won't go into our outlook. That's to be determined. We're going to have our outlook released here in a couple weeks, so more to come on that. But this year has been a good year, particularly after a lot of these other challenging years that we've seen post 2022. So just real quick on the muni side, munis underperformed last week, but we're around this 4% type return out of munis. So even the I guess the tax-free and the taxable markets are all higher this year, which is something that we like to see. So a lot of good places to invest if you're a fixed income investor this year. We'll see how the rest of the year plays out, given the give and take between the Doves and the Hawks. But like I said, December tends to be a pretty short week with all the holidays and everything. So I might actually declare 2025 over and just take these year-to-date returns as given for the year.
Yeah, 7%. Not bad at all. And certainly even a little bit better there in EM debt. You're not losing returns today. Let's see. Bond 10-year yield down 2 bips. It's Monday, November 24th. Right after lunch as we're recording this, like we always do, or almost always. 404 on the 10-year. That is a very comfortable level. And then we're getting an equity rally here. It's a variety of factors, I would say, but anyway, up 1.6% on the S&P 500. I think one of the reasons we're getting this rally is prospects for a Russia-Ukraine peace deal, which is bringing down oil prices, which is good for consumer spending, good for inflation. You've also got another continued rally in Alphabet on that Buffett stake, and some more positive AI headlines. As people reconsider maybe what they heard last week from NVIDIA. So really a nice bounce back today for the equity markets and continued strength in bonds. You see here the crude oil down to 58. That is clearly a price that is reflecting increased chances of more oil flowing out of Russia. Natural gas has actually been rallying sharply here. You see almost 20% higher over the last 3 months. Of course, we're now into winter heating season. That is more of a local market. It's not really our natural gas prices aren't trading on Russia, Ukraine. So you see nice rally there in that, although we don't want that to go too far. It helps companies, it doesn't help consumers who are heating their homes. Here you see the dollar. I priced this morning, so the week over week change in the dollar is up 0.7%. It's a pretty big move for the greenback in a week. That again trimmed international equity returns. I would just call that a little bit of a flight to safety. We are going to talk about the dollar and our outlook. I'll just say that it's going to be really important. It always is, but it's going to be especially important in 2026 in terms of the decision to overweight or underweight international equities. So that's what I want to say there. Let's look at the S&P 500 chart. So when we're in a pullback, I pull this chart out instead of my usual Adam Turnquist look at the S&P 500. And you see here, we're down about 3.5% as of, well, this was 10 a.m. East Coast time this morning after the strong open. The pullback got to a little over 5 on Thursday before the bounce back on Friday. But, you know, almost half of that is now gone. So, I mean, it's still a pullback, but minimal drawdown. First 5% pullback since May. We were due for one. We've been saying that for a long time, at least a couple of months. I would say probably started in earnest maybe in August here, where we started to get a little bit concerned about a pullback being overdue. September, October, typically weak seasonally. Didn't get it then. We're just getting it a little bit later. So the fundamental picture hasn't really changed all that much, frankly. It's just market got a little ahead of its skis, and we had to take some of the froth out. So certainly the biggest gainers in the AI complex is where you saw some of the biggest weakness, and certainly anything related to cryptocurrencies tended to experience outside losses in this sell-off as well. So that's all exciting stuff, of course, Lawrence, but not as exciting as the varied viewpoints in the bond market. I don't think I've ever been more interested in the Fed, and I'm not being sarcastic here, than I am right now. It is fascinating, right? And I'm not just talking about who's going to get fired or who Trump's going to try to fire. That's been interesting. Or who the next chair is. That's interesting. We might know something there in a couple of weeks. We'll see. But the divergence between the hawks and the doves is just massive. I find it interesting.
And it's interesting. It is almost like a daytime soap opera, given all the diverging views out there.
Reality show idea. There you go.
I don't know who would watch. I'd watch that, but I don't know how many other people would watch a reality show about the Fed. But I certainly would. But I think it is fascinating, and it is actually driving a lot of the volatility out of the bond market, as we just talked about, with rates coming down after John Williams spoke last week. But we've been getting kind of this no clear direction out of the Fed, and the reason why we aren't getting that clear direction is because these Fed officials all have different views on what to do over the next 12 months as it relates to cutting rates or even potentially hiking rates. So what we're showing here this is called a spectrometer. This is or spectrometer. This is from Bloomberg. This is from the economics team over there at Bloomberg. They do a lot of great work. But when you think about the Federal Reserve, the Federal Open Market Committee in particular, it's made up of the Board of Governors plus 5 voting members from these regional districts. And what this table shows is just kind of who's been reliably dovish, who's been reliably hawkish, and you're starting to get some folks that are on polar opposites of each other. If you look at Michelle Bowman, for example, she's a -2 according to this analysis, which means she's one of the uber doves on the committee. But then you got Jeffrey Schmidt from the Kansas City Fed, who's a +2, which means he's an uber hawk on this committee. And there's a number of other folks that kind of fit in that similar pattern. And it's been, as far as I can remember, the most divergent perspectives from this FOMC in quite some time. And it makes sense, right? We just came out of a a global pandemic, not just, but we came out of a global pandemic. We saw the inflationary dynamics that we haven't seen since the 70s, 80s, and an aggressive rate hiking campaign followed by this need or want to lower interest rates. And not everyone on the committee is fully convinced that the inflationary story is over. So we're getting all kinds of different answers here. If you look at recent statements, and I've never been a big fan of Fed speak, I think it kind of muddies the water and introduces additional volatility to markets. But if you consider the most recent comments from the 12 voting members on this FOMC, the Federal Open Market Committee Federal Open Market Committee, so far, 5 had said that they are in favor of a cut in December. 5 has said that they are not in favor of a cut in December, where 2 haven't really made their decision clear.
Well, that clears things up.
Right, exactly right. So if you're keeping score at home, which we are, 5 vote for a cut, 5 say no cut, and 2, Jerome Powell and Philip Jefferson, they have yet to kind of declare where they where they come out on a cut for December. So this could be a 6-6 tie in terms of the vote in December. I don't think there's ever been a 6-6 tie as it relates to the committee. There was a 7-5 vote back in 1983. So it's been a long time since we've seen this type of diverging viewpoints as it relates to monetary policy. Our view is, my view anyway, I still think that they're going to cut in December. Now it's going to be a lot more challenging because of the lack of data. But I do think that given the kind of bias, I think Jerome Powell is going to lean towards a cut in December. So I think we get maybe a 7-5, 8-4 vote. But it's going to be close, and until we get further clarification on that, we're going to see additional volatility in the markets. The other challenge too is that the Federal Reserve goes into its self-imposed blackout on, I think it's Saturday. So we'll have a couple weeks without Fed officials, without real, updated hard data. So markets are really left to their own devices on what's going to happen post or during that blackout period before the Fed meets on December 9th and 10th.
Yeah, they will be flying a little bit blind with the lack of at least the primary data that they normally rely on. By the way, I can't take credit for this. I got to give credit to Jeff Roach, who quoted Ben Bernanke saying that he used to refer to this as the Federal Open Mouth Committee. I think that is hysterical. Because these Fed speakers, they probably don't need to talk so much. I don't think Bernanke wanted him to talk so much, even though he did continue the shift toward more transparency from Greenspan to today. But clearly we've gone past where he thinks we should be in terms of Fed speak. So all right, so continuing the discussion on the Fed and the December cut, what's the market saying?
Yeah, this is the volatility that we just talked about. So this is the probability of a December rate cut per the Fed futures funds market, Fed funds futures market. And we got as low as about a 30% chance of a cut, call it 24.5% probability of a cut back around on the 20th. But after the conversation by John Williams, it shot up to like almost a 70% chance of a cut for December. So I think it's going to be pretty volatile. And if Jerome Powell, for example, he doesn't have any upcoming speeches that I'm aware of, but if he were to come out and say, he's not in favor of a cut, I think we would probably retrace these probabilities pretty sharply. So I think we're at this point where 1 or 2 people, if they change their mind, we're going to get this additional volatility out of the rates market and the potential for kind of a sell-off in the rates market as markets adjust to these new probability of rate cuts in December. Again, I still think that they go for a cut in December, but my conviction is pretty low on that. But if you go to the next chart, I would say that none of this matters. despite all this ongoing discussion,
You just
if you
wasted
take a
several minutes of
longer,
people's time.
if you take a
Fast forward button, fast forward button.
if you take a longer term view, markets still think the Fed is going to cut the Fed funds rate to around 3%. So whether they cut in December or January or what have you, markets are convinced that the Fed funds rate by the end of 2026 is going to be around 3%, and we agree with that as well. So again, it's one of these things where the Fed speak, I think, is doing a lot more harm than good in terms of just all these Fed officials out here debating monetary policy in the public. But I will say too, on the other hand, it does reduce there was a big narrative about the potential loss of independence by the Federal Reserve, earlier this year, and talks about how Lisa Cook should be fired, Jerome Powell should be fired. I think if we continue to get this lack of groupthink, if you will, if everyone's kind of doing their own thing and kind of voting how they think that they should vote, this committee becomes more of a larger committee versus just the opinions of one or two people, right? So I think if we do have a 7-5 vote, I think the credibility of the Federal Reserve increases because it's not just about one person anymore or two people anymore. It's about the entire 12-person voting committee. So it makes it that much harder to politicize the Federal Reserve, which I think is a good thing.
Yeah, absolutely. The way I look at it is just Powell's going to essentially break the logjam. He's been guiding a little bit more to a cut, so we're probably going to get a cut. At least that's my interpretation.
Yeah,
and
I
it
think
seems
that's
like
fair.
that's consistent with the market's interpretation too here. But I love that you put this chart in here because I still want people to focus on 6 months to a year out and the big picture, and not just try to game one Fed meeting. It's just now, granted, it moved the markets late last week, consistent with the volatility we saw in Fed funds market, but it's clearly not the end all be all. Fundamentals of the market matter. Equities and bonds matter much more than just one Fed meeting.
That's right.
So we mentioned the name Greenspan already, so here you go again. So you recently wrote a piece about how the Greenspan put, as you call it, affected the correlation of stocks versus bonds. We talk a lot about the 60-40, right? You want your bonds to zig when your equities are zagging. So what is your key message here?
Yep. So this is some self-promotion here, if you will. I did write a publication recently, the rate and credit view for our LPL advisors on the Resource Center. I do talk about how monetary policy, I think, is the bigger driver of the stock bond correlation, particularly post the 1987 episode where we had the Black Monday episode where markets were down 22%. I think the reaction from Alan Greenspan kind of changed the narrative in terms of how markets should be thinking about monetary policy. If you think about the way monetary policy was conducted pre-Greenspan, it was really this lender of last resort. Things were not as vocal as they are currently, as we just talked about. It was more of the Fed provided this lifeline to a lot of these institutions, these banking institutions, when they needed these things. Now, if you think about monetary policy, it's much more systemic, it's much more vocal, and we've seen that because of what took place in 1987, again in 1997 with the Asian financial crisis, and that was further reinforced after what took place in the long-term capital management kind of bailout, if you will. And that's when you saw these stock bond correlations flip from mostly positive to mostly negative. So, in the article I write that bonds have never been perfectly negatively correlated to equities. They haven't. They have been correlated to the business cycle, in particular the growth shocks that occur because of this countercyclical monetary policy response that took place post Black Monday with Alan Greenspan. So I think it's important on a go forward basis, if this relationship is going to hold, if we're going to get back into this negative stock bond correlation, particularly during growth shocks, I think it's important that you have a very credible Fed, a very credible Federal Reserve. So the comment I just made about potentially having less groupthink, more dynamic discussions, less focused on one or two people, I think that actually improves the credibility of the Federal Reserve, which should allow that stock bond correlation to go back down to more negative levels. But I think the conversation around 2022, 2023, as the stock bond correlation shift sharply positive, I don't think that that's enough, at least in my mind, to suggest the stock bond correlation is irreversibly broken, because what we saw back in 2022 and 2023 was an inflation shock and not a growth shock. Obviously, bonds aren't going to do well in an inflationary environment like that. But as you can see, as these rate cuts have started to come through, we're starting to see that stock bond correlation kind of shift lower as well, meaning less strongly positive correlated to each other. And I think that trend continues as the Fed credibly cuts interest rates over the course of the next year or so. Now, if the Fed starts cutting aggressively into a still high inflationary environment, then all bets are off. I think bonds aren't going to do well in that environment because, as we talked about it, during inflationary shocks, the bond market doesn't react well to that type of environment. But it should, if we get past, or once we get past these inflationary dynamics and get back into a more normal inflationary environment. I think that we will go back to that negative stock bond correlation that we've enjoyed for the past 30 years almost.
Yeah, so if the inflation side cooperates, we could still have a good bond market and a good stock market. But if you have a growth scare because yields are higher, tell me if I'm phrasing this right, you should see lower rates. So in other words, bonds up and stocks down. So bonds would provide some cushion against equity market volatility in that case. Did I get that right?
Yep, that's right. And the great thing about the current setup for fixed income is that you're also getting paid to wait in case if that ever were to happen, you're still getting pretty attractive income levels. Right. So you can build a portfolio yielding, 5-ish% out of high quality fixed income, maybe a little bit less than 5%, but around 5% for high quality fixed income. That could, I think, will still provide that ballast during a growth shock.
Very good. So stick with your bonds. They can work for you. You'll want them when you need them.
That's right.
Very good. So thanks for that, Lawrence. I'll whip through the weekly market commentary quickly, and then we'll get to the week ahead. Although we can do the week ahead pretty quickly too, because I'm not sure we know what data we're going to get and when, because of the shutdown delays. So corporate America clears a high bar, hat-tipped profit margins. I actually think the expansion in profit margins is the biggest surprise this quarter, and talking about Q3, and the most impressive achievement. I'll show you that here in a minute. But first, here's your growth rates. If you include Meta's $15.9 billion tax charge, you still are growing 13.5% year over year S&P 500 earnings in Q3. That is, even with that drag, which is 2 points, almost double the expectation when earnings season began in early October. Of course, if you take that charge out, you've more than doubled the initial expectation. That is a very big upside surprise at this stage of the earnings cycle. It's typically as the bar keeps getting raised and raised and raised, which certainly it has been doing the last couple quarters, the surprises tend to get smaller. Well, that didn't happen in Q3. And what's most impressive, the reason I'm underscoring this is because tariffs came through in Q2 and Q3, and more were paid in Q3. So despite that ramp, companies were still able to generate some margin expansion and this, therefore, really strong earnings growth rate. Of course, the Mag 7 was a big part of it. About half of the earnings growth came from those names. Again, X that Meta charge. It looks like chances are good we're going to have a string of double-digit earnings growth in S&P 500 for, I think, 9 quarters. I don't know about, I mean, early 2027 is hard to call at this point, but it looks like we've got a really good chance at a 9 quarter double-digit earnings streak. The tricky part's going to be Q4, current quarter, where we're going to need a few points of upside. I still think we get it, especially with the CapEx from AI names, but it's certainly not in the bag because we'll need that upside to come through. Here's your big driver, the Mag 7 earnings growth, Mag 7. If you factor in NVIDIA and take out the Meta charge, you're at 30% plus. But with all the numbers in, 28, still a very solid earnings growth number for that group. By the way, the 493, the rest of the S&P 500 grew earnings about 10%. So it's not shabby at all, but clearly the most earnings growth and the biggest driver is coming from big tech. And even if you look at 2026 numbers, still 20% plus. CapEx in tech is going to grow 20% plus with all this data center build out and all the AI chips and all that. So there's upside to these kind of 20% numbers next year. But even if we only grow earnings in the Mag 7 by 20% next year, that's pretty good. So as I mentioned, tariffs were absorbed in Q3 more than in Q2. We've actually absorbed about 11 points already. So maybe there's a couple points more to go. We'll see, maybe not, because we've gotten more exemptions. It's hard to say where some of these higher rates go in terms of negotiations. India, Brazil, I think Switzerland, we already got a compromise. So there's potentially more tariffs to come, but not a ton. Maybe we'll end up landing in the 12, 13% range. Clearly, the market or companies were not bothered very much in Q3 because here you see it wasn't much, but you got a little bit of operating margin expansion Q2 to Q3. And then we're expected to see more over the next several quarters as AI productivity gains come through and the tariff drag diminishes, right? Because once it's absorbed, then your comparisons against those numbers are easier going forward. It's really the period where you absorb them that's the toughest on margins. So we're going to call that a big win. Lastly, earnings growth estimates rose during earnings season, which is rare. I feel like I've been talking a lot about this over the last couple of years as this AI spend has come through. Consensus right now about 305 on 2026 earnings. That provides a strong foundation if we can actually get it. This is just really impressive. Remember, estimates typically fall during earnings season. So strong foundation underneath this market, even though stocks are a little expensive. If earnings can grow, this is a 14% earnings growth number, by the way. We don't think we're going to get that, but we're going to get close to it, we think. Anything in the double digits is probably enough to support stock prices at current valuations, especially if Lawrence's bond market cooperates, which is going to require some help from the Fed and some help from inflation. All right, so that's a quick summary of the weekly market commentary. Again, you can find that on LPL.com under the research tab. Just a recap of earnings season with some comments from Adam Turnquist about the tactical environment. In terms of the week ahead, stale data, fresh turkey, limited visibility. Lawrence, what are you watching this week? I know we're going to be done with Fed speak pretty soon here. Any of this data do you think actually comes through and does it matter? Well, I mean, it's stale, so maybe I answered my own question.
Yeah, I think that was the takeaway, at least as far as I'm thinking about the data. This is September data. We're almost through the end of November. It doesn't look like we're going to get any sort of October data as it relates to job data, et cetera. So the beige book, the Fed beige book, is interesting. I think that comes out this week on what day is that? Wednesday. So maybe there's some additional information there. But I think a lot of this data is going to be just potentially looked over because of just the fact that it is stale. One thing that's not on here, though, that I know as a fixed income person that I'll obviously be paying attention to is that we do have Despite a holiday shortened week this week, we do have over $200 billion of treasury auctions that are coming to market this week. We had a 2-year auction today, just at 1 o'clock Eastern today, and it was fine. But you'd expect that with a 2-year auction, so there's not a lot of interest rate volatility there. But we do have a 5-year and a 7-year auction as well. So we'll have to see how the 7-year auction goes to determine demand for these longer maturity securities. The 10-year and the 30-year auction a couple of weeks ago were objectively meh, I think is what the kids say. Meh. It wasn't. They weren't great. They weren't horrible, but they were just kind of. There wasn't a ton of demand for these longer maturity securities, so that continues to be a challenge for fixed income markets. It's just there's not a lot of demand for these longer maturity securities, not only in the U.S. but in Japan and elsewhere. So we'll have to see how this week plays out for Treasury auctions.
Yeah, thanks for bringing that to our attention. I guess holiday volume's just going to thin out. People are going to continue to pay attention to the private data uh, as long as it's timely, right? So I think, or it's so timely that the government can provide it as usual, right? So they can't do the unemployment rate, but they can do payrolls. So I guess once we get payrolls, it will be timely. Initial jobless claims will be timely. The Fed Beige Book obviously will be timely. Um, but a lot of this stuff is just like retail sales. I don't think it matters, right? It's stale. It'll be interesting to see what the consumer was doing in September, but we've heard more recently from corporate America earnings season, and what, 6, 7 weeks has passed since then. So I think what's happened in the last 6, 7 weeks, or what's going to happen in the next month, matters more with holiday shopping and Black Friday and all of that. There is correlation between the stock market and holiday shopping. So I think you probably end up with a nice holiday season. I don't have a forecast, but I would be surprised if it's not north of 4 in terms of percent year over year Black Friday or a holiday shopping season versus last year. It's a pretty, even though confidence is down, even though maybe the job market's a little bit weaker, you still have low unemployment. You have a really strong stock market. You still have a pretty strong housing market. We're probably going to get a little bit of an uptick from last year. So I think that's all I've got to watch this week. Other than that, everybody start getting ready for your Thanksgiving plans. I certainly will do my part and eat a lot. Lawrence, I'm guessing that you'll be able to do the same. But most importantly, just everybody enjoy time with friends and family. That's of course what it's all about. I'll speak for you, Lawrence. I think we both have a lot to be thankful for, and certainly wish everybody a really nice holiday. So thanks, Lawrence, for the update on the bond market. Really, again, Fed is as interesting as it's ever been, I think, right now. So appreciate your insights there. And we'll talk to you next time. Thanks, everybody, for listening to Market Signals. Have a great holiday, and we'll see you in a week.